Forget for a moment the obsession with hunting for the perfect entry. Your first and most critical task isn't on the chart, it's in your mind to rewire yourself, to transform from a hope driven gambler into a cold, emotionless, probability calculating machine. This is the 10-minute rule before trading, a disciplined mental and strategic preparation protocol designed to eliminate all noise. Its sole purpose is to ensure that, at the exact moment your finger hits the enter key, the decision is a calculated act of a professional trader, not an impulsive reflex of a gambler. This is the starting line. The moment you strip away chaos and step into the pure state of discipline and probability. Minute 1 to minute 3, stabilizing the mind, the path to purity. In finance, everything is quantified and calculated, but these first 180 seconds belong entirely to pure psychology. This is the moment professionals quietly refer to as meditation before battle. We don't step onto the trading desk from the gym or the library. We arrive straight from the chaos of everyday life, ringing phones, unpaid bills, unresolved personal pressure. Your brain, a survival machine hardwired for speed, fear, and greed, is operating in a high beta state, tense, hyper alert, and flooded with cortisol. The instinctive move of most losing traders the moment they open their laptop is to dive straight into the charts. They do it with an overstimulated brain, unconsciously dumping the emotional baggage of their personal lives directly onto the financial battlefield. The rule here is absolute. Do not open the chart. The chart is a matrix engineered to trigger greed and fear. If you look at it before your mind is clean, it will control you. Wall Street doesn't pay for excitement. It pays for boredom, discipline, and the ability to see reality exactly as it is, undistorted by emotion. The purpose of these 3 minutes is not to find profit, but to create a flat brain state, alpha or theta, where logic and patience take control, replacing the impulsive dominance of the amygdala. You play a familiar piece of music, steady and even, like a metronome for the mind. No climax, no stimulation. The goal is a predictable sound environment, safe enough for the body to automatically shift into relaxation and focus. The music is only a tool. The real anchor is the breath. Slow it down. Inhale for 4 seconds, hold for 2, exhale for 6. Heart rate drops into its optimal zone, and you send a clear signal to the parasympathetic nervous system that you are safe. Only when the brain feels safe can it operate at a higher level. The cold truth of Wall Street is this. Losing traders enter the market with a clenched mind, carrying the weight of yesterday. Consistently profitable traders place risk only after the brain has been flattened, cleared, and stripped down to nothing but cold probability calculation. These 3 minutes are the highest return investment of your day. They are the ritual that transforms the brain from a survival device into a profit-generating machine. Minute 3 to minute 5. Open the economic calendar. Know which arena you're playing in. If the first 3 minutes are about cleaning the room of the mind, the next 2 are about checking the market's weather and measuring the risks hanging overhead. This is the transition from personal psychology to macro context, where risk stops being emotional and becomes a variable to be clearly defined. Losing traders use the economic calendar as a prediction tool. They try to guess whether the news will be good or bad, up or down, and then jump in before the number is released. That isn't trading. It's pure gambling with no probabilistic foundation. Professional traders view the calendar as a risk map. The goal isn't to trade the news, but to know precisely when to stay out. You scan quickly for high-impact events. 3-star releases capable of pulling the market out of order and throwing it into chaotic volatility. Non-farm payrolls, Fed rate decisions, CPI data, central bank statements, these are not opportunities. They are sources of noise. You don't analyze the content of the news. You simply register its potential for damage. Next, you define the exact blackout windows. When does the news hit? Which market does it affect? Which instruments sit inside the danger radius? If the European Central Bank announces its decision at 7:45 p.m., then from 7:30 to 8:30 p.m., any euro-related pairs are a no-trade zone. No debate, no exceptions. The Wall Street mindset here is simple. We don't need to know whether the news is good or bad. We only need to know when not to have a conversation with the market. During major news releases, the market doesn't operate under your familiar technical rules. It's driven by high-speed algorithms and large funds rebalancing positions. Trading into that is a direct confrontation with forces you can't see. The market is always trying to eliminate the unprepared. Inexperienced traders die by the news. They get caught in two-way candle spikes, stopped out in seconds, and react with panic. Professional traders only lose when they don't know there is news. Knowing the news in advance doesn't mean fear. It means managing uncertainty. You can choose to stand aside completely, trade with significantly reduced risk, or wait until the news is absorbed and the market regains structure. In these 2 short minutes, you've built a safety framework that ensures your technical system won't be destroyed by a macro shock that was scheduled in advance. Minute 5 to minute 7. Read structure. Define your strategic position. Once the mind has been flattened and macro risk clearly contained, this is the moment you're finally allowed to open the door to the market. But understand exactly what that means. You're not stepping in to find a trade. You're stepping in to position yourself. This is not hunting, it's reconnaissance. The biggest mistake amateur traders make is believing that opening a chart means they must do something immediately. Professional traders open charts to understand where they stand before deciding whether to act at all. During these 2 minutes, the chart is not a flashing casino floor. It's a military map. You're not looking for firing points. You're reading terrain. You observe the market the way a reconnaissance pilot flies at high altitude, surveying the entire battlefield before a single unit is deployed. This is the difference between strategy and reflex. Losing traders start by zooming straight into lower timeframes like M5 or M15. They see every candle twitch, every minor pullback, and their brain is instantly dragged into a 5-pip, 10-pip hunt. That's the perspective of an infantryman sprinting through gunfire without knowing which front he's on. Professionals do the opposite. They start with higher timeframes, D1 or H4. They don't ask the market where to enter. They ask it 3 survival-level strategic questions. The first question is the primary trend. Is the market up, down, or sideways? There is no gray area here. This is not a place to showcase analytical ego or subtle market interpretation. This is a place for discipline. If the trend isn't obvious within the first 10 seconds, it's not clear enough to risk real capital. The market doesn't pay for intelligence, it pays for compliance. Trading against the primary trend isn't a tactical mistake, it's an act against probability itself. The second question is the market's current state. Is it expanding or contracting? An expanding market moves aggressively in one direction, printing higher highs or lower lows. This is the phase of momentum, decisiveness, and extended runs. Trading here requires wider stops, clearly defined targets, and acceptance that you won't catch tops or bottoms. A contracting market, by contrast, is compressed, oscillating within a narrow range, storing energy. This is the patience phase, where impatient traders bleed accounts through spread costs and repeated false breaks. Knowing which state you're in determines whether you press forward or stand down. The third question is the level of order. Is the market moving with clear structure? Order shows up as logical sequences. Higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend. Chaos is constant whipsaw, stop sweeps, false breaks, abrupt reversals with no logical footprint. Trading an orderly market is flowing with the current. Trading chaos is fighting in the dark. Once these 3 questions are answered, you move into noise elimination. This is when the chart must be completely naked. No indicators, no colors, no filters. Every technical indicator is ultimately a derivative of price, lagging, and often creating an illusion of certainty. At this stage, they don't clarify structure, they only occupy mental bandwidth. You need to see price as it is, without any lens. You also do not zoom into detail. Magnifying individual candles is the fastest way to lose the big picture. Keep the chart wide enough to see at least 3 to 4 major swings. Those swings tell you the real story of the market. Details only tell you fragments of short-term emotion. Most importantly, throughout this entire phase, do not hunt for entries, not even mentally. Even a passing thought like, "I'll buy here" or "I'll sell there" must be killed instantly. The moment you imagine an entry, you've left the role of observer and stepped into the role of someone imposing personal will on the market. The market always punishes that with real money. The survival logic here is simple. Where are you standing? Are you in a forest with clear rules, where every path aligns with a dominant direction? Or are you in a minefield, where every step can trigger a random explosion? If it's a forest, you can continue. If it's a minefield, the smartest move is often to stand still. Identifying structure won't make you money immediately, but it determines whether you'll still have money to make tomorrow. It positions strategy before tactics are deployed. If the market is trending up, you only look for buys, regardless of how violently the lower time frame shakes. If the market is sideways, you're allowed to do nothing or participate only with reduced size on clean breaks. There is no worse strategy than trading against higher time frame structure just because an M5 signal looks beautiful. These 2 minutes may feel short, but they are the dividing line between systematic trading and emotional trading. They ensure that every decision that follows serves the big picture, the primary flow of the market, not a random spike that merely makes you feel active. This is how professionals survive, not through superior intelligence, but through the ability to stand in the right place before even considering the next step. American English, Wall Street tone. Minute 7 to minute 9, run it through the system, validate the trade's legitimacy. If the first 7 minutes are about clearing the mind, containing macro risk, and positioning yourself within market structure, these 2 minutes are the final purification ritual. This is no longer about context or feel. This is the moment you bring the potential trade before your own court of law. It's either legal or it's rejected. There is no gray area. At this point, you must accept a truth most traders never dare to face. The majority of what you call opportunity is simply the ego's desire to make money disguised as analysis. These 2 minutes exist to expose that illusion. Every professional trader operates off a trading system that has been validated by historical data, not by emotion or momentary intuition. That system is not an idea, not a style, and certainly not a belief. It is an objective rulebook, written in clear, quantifiable conditions that require no interpretation. The system exists to make decisions for you when you are no longer in a state fit to trust yourself. During these 2 minutes, you do not ask the market whether today is a trading day. You ask your system one and only one question. Does this trade fit the system? Not almost. Not close enough. Not acceptable. Only yes or no. You begin by matching the current market context against the rules already written in your trading journal. Location rules are the first gate. Is price actually in the strategic zone the system requires? Is that support or resistance level one that's been validated multiple times? Or just a line you drew 5 minutes ago to comfort yourself? Is price inside a valid trend channel or floating in no man's land where probability doesn't belong to you? If location fails, everything that follows is irrelevant. Next come the confirmation rules. Have the required signals actually formed? Not about to form, not showing signs, but fully formed and confirmed by clear price behavior. If your system requires a candle close outside the Bollinger Bands and a return inside, has that candle closed? If it requires a break of structure and a retest, has the retest occurred, or are you hoping it will happen in the next few bars? The market only recognizes what has already happened. It has no interest in your expectations. Finally, the risk rules, the part the ego most desperately tries to avoid. Does the risk-to-reward ratio meet the system's minimum requirement? Not in an ideal scenario, not if the market behaves, but in reality, with a logical stop-loss and a realistic profit target. If the ratio doesn't qualify, the trade is illegal, no matter how beautiful everything else looks. If even one of these rule sets fails, the trial is over. The trade is dismissed. Here's where most traders slide down the slope of justification. The moment a scenario looks attractive, the brain starts subtly loosening conditions. It doesn't lie loudly. It whispers. Price hasn't reached the zone exactly, but it's close enough. The indicator hasn't fully confirmed, but the signal looks strong. The risk-reward isn't ideal, but momentum is good. We can be flexible. Every one of those arguments sounds reasonable, and that's precisely why they're lethal. The moment you start explaining, rationalizing, or defending a trade, the answer is already no. A valid trade doesn't require debate with yourself. It doesn't need persuasion. It fits the system cleanly and coldly, line by line. If you have to think too long, if you need reasons to allow yourself to enter, that isn't a trade. It's a concession. Losing traders try to force the market to conform to their need to make money. They've invested nearly 10 minutes preparing, and the idea of standing aside feels like missing out. They can't tolerate ending a long process without a tangible action. So they lower the standard bit by bit until the trade feels just legal enough to be emotionally comfortable. Surviving traders are different. They don't see not trading as failure. They see it as the normal outcome of a disciplined system. They understand that the real power of a system isn't in the winning trades, it's in the number of bad trades filtered out before capital ever hits the market. For them, rule compliance matters more than the result of any single trade, because long-term outcomes are nothing more than short-term discipline repeated long enough. In these 2 minutes, you are not a trader. You are a judge. Cold, uncompromising, unbribed by emotion, time, or expectation. You're not judging the market. You're judging yourself, checking whether you're following the system or looking for a loophole. If there isn't a 100% match, you close the analysis window. No adding indicators, no switching timeframes to hunt for new evidence, no extending time in the hope that something will appear. You stop, and you prepare for the final decision that very few people are strong enough to make calmly. Stand aside. These 2 minutes won't make you money today, but they determine whether you'll still be qualified to make money in this market next month. This is where ego is contained, the system is honored, and amateur traders are quietly eliminated. Not by the market, but by the discipline they were never strong enough to maintain. Minute 9 to minute 10, the final decision. Trade or stand aside. After completing the entire process, emotional stabilization, macro risk containment, structural market reading, and system-based trade validation, you are no longer missing any data. Everything that needs to be known is known. Every objective variable has been addressed. This final minute no longer belongs to the market, it belongs to you. This is where many traders collapse, not from lack of knowledge, but from a lack of strength to not act. Minute 10 doesn't measure your analytical skill. It measures your ability to maintain discipline when all conditions are already on the table. In the final 60 seconds, you must do something that runs directly against a trader's natural instinct. You take your eyes off the chart. You don't look at price. You don't look at candles. You don't look at anything that could re-trigger the urge to act. You can close your eyes or look out a window, somewhere with no charts, no numbers, no movement. The goal isn't relaxation. The goal is to completely sever visual temptation, because the human brain is easily manipulated by price motion in the final moments. You allow yourself to ask only one question, a question that has nothing to do with profit, nothing to do with being right or wrong, and everything to do with your long-term survival in this business. If this trade loses, will I still be able to stay disciplined and follow my rules on the next trade? This question is decisive because it completely inverts amateur thinking. Beginners ask, what if this trade wins? Professionals ask, if this trade loses, will I still be myself? If the answer in your mind is yes, without hesitation, without persuasion, without conditions, then it means you've done everything correctly up to this point. You've fully respected the system. The risk you're taking is familiar. The potential loss, if it occurs, doesn't threaten your psychology, doesn't shake your confidence, and doesn't push you toward revenge trading. In this case, a loss is simply a cost of doing business, no different from rent or electricity for a company. You don't enjoy losing, but you aren't damaged by it. When you reach this state, you are qualified to trade. If the answer is uncertain, or worse, you dodge the question by thinking about potential profit, you stop immediately. That uncertainty doesn't appear randomly. It always has a cause. Somewhere between minute 7 and minute 9, you may have quietly loosened a system rule you didn't want to admit. Your position size may be larger than what you're truly comfortable with, even if it's technically within risk limits. Or you may be trading under pressure after a losing streak, carrying a silent desire to win back what was lost. Whatever the reason, the moment there is doubt about your ability to accept a loss calmly, the trade is no longer valid. Any trade that has the power to break your future discipline is a losing trade the instant you click the button, even if it later closes with a 10-pip profit. The market may pay you for that trade, but you've paid with psychological stability, and that price is always higher than short-term gains. This is where the concept of standing aside reveals its true value. Most traders see standing aside as missing out. Large funds see it as an investment decision. Wall Street doesn't pay people for trading every day. It pays people for knowing which days not to trade. Long-term profitability doesn't come from the number of trades you take, but from the number of bad trades you avoid. Standing aside is not passive. It's an active act of capital protection, financial and psychological. When you stand aside, you preserve 100% of your financial capital and 100% of your mental capital for the next opportunity. You aren't eroded by transaction costs, distorted by random outcomes, or pulled into the emotional cycle of wins and losses. You keep yourself in optimal condition, and that is the single greatest competitive edge a retail trader can have. When the 10-minute process ends, there are only two clear outcomes, no third option. If the final decision is to stand aside, you close the computer. No more charts, no switching to another pair to feel better. You step away from the market and continue your day. Not trading today is a complete decision, not a gap that needs to be filled. If the decision is to trade, you execute exactly as planned. Entry where it was defined. Stop loss where it was defined. Take profit where it was defined. Once the order is placed, you take your hand off the mouse. Analysis is over. From that point on, any intervention is a breach of discipline. The market will do its job. It doesn't need your help. This 10-minute rule is not an entry strategy. It doesn't promise frequent trades. It doesn't make you feel excited. It is a mental capital management process. It ensures that every time you step into the market, you do so with a clean mind, a correctly read context, a respected system, and a mindset ready to accept both wins and losses with the same composure. In a game where most participants are eliminated not by lack of knowledge, but by loss of control, this process is a survival barrier. It doesn't make you smarter than the market. It prevents you from sabotaging yourself. And in trading, that alone is a decisive edge. If you're serious about trading as a profession, not a gamble, the first thing you need to build isn't a strategy, it's a mindset. Trading Mindset Lab exists for one purpose only, to sharpen the thinking, discipline, and psychology of traders who survive and make money consistently. Subscribe to Trading Mindset Lab, not for entertainment, but to train the right way of thinking in a game where even the smallest mistake is paid for with real money.